This is the Boom 1000 index and this is a Crash 1000 index. On the 1 minute time frame, they both look like they're going in the opposite direction. The long bars are called spikes. On Boom 1000, the spike goes in the upward direction, hence the name Boom. On Crash 1000, the spike goes downward, hence the name Crash. The strategy seems straightforward if you zoom out from either of these charts. Catch the spikes or ride the wave after the spike. In fact, we've done this before on this channel. Immediately a spike would happen, we'd get into a trade and ride the wave. This strategy works until it doesn't. Therefore, how can we use different indicators to build a profitable strategy? What happens if we add 1 or 2 trend indicators? What if we add a momentum indicator and another momentum indicator to be doubly sure? How about support and resistance? Is that it? What does it take? Let's find out. This is Perry Kaufman, and he invented the Kaufman Adaptive Moving Average, short for AMA. The AMA is not like your typical moving average. Take the Boom 1000 index chart. If we add a simple moving average, we get this line. If we add an exponential moving average, we get this line. If we add the adaptive moving average, we get this line. If you look closely, the simple and the exponential moving averages are lagging, while the AMA seems to adapt very quickly to price changes. Unlike traditional moving averages that use a fixed window size, the AMA adjusts its sensitivity to price changes based on market volatility. This makes it more responsive to trends in volatile markets and less prone to false signals in choppy markets. In an attempt to catch spikes or ride the wave, the adaptive moving average works for both cases. To catch the spikes on Boom 1000, we need to figure out the start of the uptrend. To ride the wave, we will need to figure out once a spike has ended and whenever a candle closes below the AMA, we get into a downtrend. This is by no means a perfect strategy, and we need to test it out, of course. To build a trading bot that uses this strategy, we need to remember that spikes do not respect the stop loss. If you miscalculate and get in a trade at this point, despite placing a stop loss here, the final stop loss would actually be here. This behavior cannot be mitigated even when using a trading bot. This then posits a good question. How can we then manage our money if the stop loss doesn't work? How is this not considered gambling? If we decide to ride the wave, what happens if the spike goes beyond our entry position despite having a stop loss? I have done extensive code research and concluded that this never really works, and so have very many people on different forums. This then brings us to a crossroad. Do we place trades anticipating spikes, or do we place trades riding the wave after the spike? And more importantly, how can we use the AMA to do this? If we trade only based on the spikes, we would have to place buy trades on Crash and sell trades on Boom. To make this deep dive, let's focus on Boom 1000. The first iteration of the bot was combining the selling and the buying. When the price of the currently forming candle closes above the AMA, we get into a buy anticipating a spike. When the price closes below the AMA, we get into a sell position to ride the wave. I performed a backtest over a 5-year period. Fun fact, this is all the time that the Boom 1000 has existed. It was introduced in 2019. So we're essentially carrying out a backtest on all the data that's out there on the Boom 1000. So anyway, back to the backtest. The backtest could not be completed because we ran out of money a couple of months into the backtest. So I did some more research, and further research showed that the AMA strategies suggest waiting 10 consecutive high or lows before getting into a trade. On boom 1000, this would be waiting for 10 consecutively falling AMA values, then placing a sell trade. This works great when we have a strong downtrend, but the minute a spike happens, we do risk losing more than we have made due to the slippage we talked about earlier. In the same breath, we also cut out the noise on very short downtrends. Therefore, the new strategy then becomes wait for 10 consecutively falling AMA values, make sure the 10th candle is below the AMA, and then place a sell trade with a risk-reward ratio of 1:2. We have to manage money somehow. That's why I started off with a risk-reward ratio of 1:2, which has also worked pretty great in the past. Performing a backtest using this new iteration, we ended up hitting the same snag. The spikes seem to wipe us clean every time. But that's just the sell. What about the buy? This brings a counter strategy to light. What if we place a buy in anticipation of the spike? On the one hand, this would be perfect if after the 10 candles we get a spike immediately. However, on a strong downtrend, we would hit stop loss after stop loss. Anyway, let's just test the buy strategy as well, which then becomes wait for 10 consecutively falling AMA values, make sure the 10th candle is below the AMA, and then place the buy trade with a risk-reward ratio of 1:2. I performed a backtest with this buy strategy and it was the same thing. We lost money at some point. Therefore, the backtest stopped because the account ran out of money. So looking at both tests with the 10 consecutive falling AMA values, the buy and the sell, while the final balance does not indicate how good each strategy is, I will focus on improving the sell setup going forward. Donald Lambert introduced the CCI indicator in 1980. It is used to detect divergence from price with overbought and oversold conditions. The CCI oscillates above and below a zero line. Oscillations between 100 and -100 are considered normal levels. Readings above 100 imply overbought conditions, while readings below -100 imply oversold conditions. Before I can introduce the CCI to our strategy, I wanted to switch gears on money management instead of using the take profit and the stop loss with a risk-reward ratio of 1:2. The new strategy will now switch gears to using a trailing stop loss in an attempt to ride the wave as much as possible. Here's how trailing stop loss works. We get into a trade at point A and place a stop loss X points away from the entry price. When the price moves in the favorable direction with Y points, we move the stop loss with Y points, hence the name trailing stop loss. Adding the CCI to the AMA will then give us a revised strategy, which then becomes wait for 10 consecutively falling AMA values, make sure the 10th candle is below the AMA, make sure the CCI is below -100, then place a sell trade with the SL being X points away. And things start off so well, and the strategy was making money. Then this happened. Again, we ran out of money. While this is discouraging, It suggests that pairing the CCI and the AMA did something, up until this point anyway. The RSI indicator was introduced by Wells Wilder in 1978. It is used to detect momentum in price movements and identify overbought and oversold conditions. The RSI oscillates between 0 and 100. Oscillations above 70 imply overbought conditions, while oscillations below 30 imply oversold conditions. The RSI also has a center line at 50, where values above 50 generally indicate bullish trend and values below 50 indicate a bearish trend. To incorporate the RSI to our current strategy, we'll then need to use the below 30 level. The reverse sell strategy then becomes wait for 10 consecutively falling AMA values, make sure the 10th candle is below the AMA at that point, make sure the CCI is below negative 100, make sure the RSI is below 30, and if all these conditions are met, place a sell trade with the LCL being X points away. And things start off well, then something happens again. It's as though the RSI made zero impact, and we end up in the same spot, running out of money. George Lane introduced the stochastic indicator in the late 1950s. This indicator detects momentum in price movements and identifies overbought and oversold conditions just like the RSI. It also oscillates between 0 and 100. Oscillations above 80 imply overbought conditions, while oscillations below 20 imply oversold conditions. This indicator consists of two lines, the K line, which is the main line, and the D line, which is a moving average of the K line. Crossovers between K and D lines are used to generate trading signals. A bullish signal is generated when the K line crosses above the D line, indicating a potential buying opportunity. When the K line crosses below the D line, a bearish signal is generated, indicating a potential selling opportunity. Going back to our chart, if you add the stochastic indicator, by the time the RSI is below 30, the K and D lines are consistently below 20, and the two are always on the same level. Because of this, the revised strategy then became wait for 10 consecutively falling AMA values, make sure the 10th candle is below the AMA at that point, make sure the CCI is below negative 100, the RSI is below 30, and both the K and the D line are below 20. We then place a sell trade with the LCL being X points away. And things start off well. Then something happens again. Support is a price level where a downtrend pauses due to a demand in concentration. When the asset's price drops to this level, it becomes more attractive to buyers, increasing demand and often halting further decline. Resistance, on the other hand, is a price level at which an uptrend tends to pause due to a concentration of supply. As an asset's price rises to this level, it becomes less attractive to buyers, increasing selling pressure and often stopping further rise. Going back to our 1 minute chart, we need to decide which time frame to draw the support and resistance lines. If we use the 5-minute period, we get this support and resistance lines. If we use the 15 minutes, we get these two lines. If we use the 1 hour, we get these two lines. 4 hours, get these two lines. Ended up settling for the 5-minute time frame to use as our support and resistance. The new strategy then became wait for 10 consecutively falling AMA values, make sure the 10th candle is below the AMA at that point, make sure the CCI is below the negative 100, RSI is below 30, the stochastic oscillator is below 20, and the current price is below the resistance level. And again, things start off excellent until something happens. So what is happening at this point? On the one hand, synthetic indices look like a money-making machine for traders. On the other hand, the algorithms underlying the prices are not pegged to some real-life event. Unlike stocks or financial instruments, we cannot say the price increased because a new drug or a technology was invented. However, I did investigate what was happening at this specific point. The date that the strategy seems to fall off is February 18th, 2022. If you go back to your Boom 1000 chart and scroll back all the way to this date, you realize two things happened. One happened at 4:35 a.m. and the second occurred at 8:02 p.m. We have like a gap. So what causes this gap? Ended up reaching out to derivative support, and they said this was due to an algorithm change. So on one day, we had the algorithm change twice. That's not even the crazy part. The crazy part is that we have no control of when it changes. We're not notified on when it does even change. We don't have a back-end view of what is happening. It's really crazy that this is even legal, to be honest. However, I'm not giving up. I want to try out more technical indicators and see whether we're gonna get a viable solution to make money in the long term. However, this being an algorithm-centric asset, I can't help but wonder, is there an algorithm that can also be used to make money as well? So before I explore other algorithms, I want to first of all just cover as many technical indicators as I can. So one thing maybe you've noticed from the approach we did today is we could introduce something like a cutoff instead of just riding the wave, because every time we ride the wave and then a spike happens, which is bigger than the wave we've been riding, we get into a loss. So what if instead we, after the 10 consecutive falling AMA values, all indicators, include all the indicators we still had, but instead of waiting for the trailing stop loss to be hit, which in theory is heavily dependent on if the spike is big enough to wipe out all the profit we've been making, we limit it to like maybe 5 candles. After the 10, we say we'll only ride the wave for 5 candles, for example. Something else to note is that the quality of the backtest data was not great. A huge chunk of it is missing. This means that there are days when we calculate the indicators with faulty data because of the missing pieces. There's really nothing I can do about this because unfortunately the crash and boom indices only work on deriv. Therefore, I do not have another source of data to use. Nonetheless, I have linked all the trading bots in this experiment with the first link in the description. And bonus points, the bots also work for other financial instruments. So you can try this on whatever stock you want, whatever currency pair. And I will see you on the next one.